What if I told you that something can become incredibly valuable, not because of what it is today, but because of what people expect it to become? That expectation, that forward-looking belief, is what quietly drives the stock market. And once you start to notice it, you'll see it in almost every move. Because prices don't wait for certainty, they move on possibility. They react to what might happen next. And that shift in thinking changes everything. It turns the market into something far less predictable and far more human. What if something could grow in value, not because it has already proven itself, but because people are convinced it will? That idea might sound strange at first, but it sits at the center of how the stock market moves. And once you start noticing it, you begin to understand why prices rarely stay still. At a basic level, the stock market is not as complicated as it seems. It's a place where ownership in businesses is divided and exchanged. Instead of buying a product, you're buying a portion of a company. That portion connects you to what happens next. If the company expands and improves, your portion can become more valuable. If it struggles or loses direction, that value can shrink. This simple connection is what brings people into the system. As businesses grow, their needs grow with them. They require more resources, more people, and more reach. At some point, relying only on internal funds becomes limiting, so they choose to open participation to others. Ownership is divided into smaller units and made available to a wider group. This allows the business to gather the resources it needs while giving others a chance to be part of its journey. Once these units are available, activity begins immediately. People make decisions based on their expectations. Some decide to enter, others decide to leave. These decisions create movement in price. When more people are interested in entering, prices tend to move upward. When more people choose to exit, prices tend to move downward. This process repeats constantly. What makes this system dynamic is that expectations rarely stay the same. New information appears, conditions shift, opinions evolve. Even small changes can alter how people see the future, and when those views change, decisions change with them. This is why prices adjust so frequently, not because the business changes every minute, but because perception does. At any given moment, people are looking at the same situation in different ways. One person may see potential, another may see uncertainty. Both are responding to the same reality, yet their conclusions are completely different. This difference in perspective is what keeps the system active. Without it, there would be no exchange. By the way, if you enjoy breaking down complex ideas like this in a way that actually makes sense, make sure to subscribe. Because this channel isn't about random hype, quick predictions, or telling you what to buy. It's about understanding how systems really work, why markets move, why people react the way they do, and how psychology, behavior, and expectations quietly shape almost everything happening behind the scenes. So if you want to see the market with more clarity, instead of just watching numbers move, you'll probably enjoy what's coming next. When enough people begin to act in the same direction, momentum starts to form. A gradual move can turn into a stronger one. As more attention is drawn in, more participation follows. This can push prices further than expected, but momentum does not last forever. It eventually slows, changes direction, or fades. The market is not isolated. It responds to a wide range of influences. Business updates, policy changes, economic conditions, and global developments all play a role. These influences do not arrive one at a time. They overlap and interact, which is why short-term movement can appear inconsistent. Another important factor is the difference in time frames. Some participants are focused on immediate movement. Others are focused on longer-term direction. This difference leads to contrasting actions. A short-term reaction may not align with a long-term view, yet both exist in the same system at the same time. Information is constantly flowing, but information alone does not move the market. It is the interpretation of that information that leads to action. Two people can receive the same update and reach opposite conclusions. One may feel encouraged, Another may become cautious. Both responses contribute to overall movement. There is no point where uncertainty disappears. Even with strong data, future outcomes remain unclear. Decisions are made without complete certainty. This is not a flaw in the system. It is a defining feature. Learning to operate within that uncertainty is part of participating in the market. Because no one truly knows what happens next with complete confidence, people can study charts, follow the news, and analyze data, but the future can still surprise everyone. And that uncertainty is what keeps the market moving. Over short periods, movement can seem scattered. Prices shift quickly, often without an obvious pattern. But over longer periods, a clearer trend can develop. Businesses that continue to improve often reflect that over time. Those that lose direction tend to decline. This process is gradual, not immediate, because real growth usually takes time. And in the short term, markets can be emotional, noisy, and difficult to predict. Today, access to the market is widely available. Participation no longer requires special connections. With basic tools, almost anyone can be involved. This has increased activity significantly. But access alone does not create understanding. Without a clear approach, it is easy to follow movement instead of understanding it. Many people enter the market simply because they see others making money. They follow trends, react emotionally, and chase fast movement without fully understanding what is happening. And over time, that can lead to poor decisions instead of clear thinking. One of the biggest challenges is managing reactions. Frequent movement can create a sense of urgency. It can feel like action is always required. But not every change requires a response. Distinguishing between meaningful movement and temporary noise is essential. Instead of focusing on every shift, it can be more useful to observe patterns. Looking at how movement develops over time can provide better context. Because when you focus on every small move, the market can start to feel chaotic. But when you step back and look at the bigger picture, the movement often begins to make more sense. This approach reduces the pressure to react instantly and allows for clearer thinking. At its core, the market reflects behavior, not just numbers, but decisions. Expectations, adjustments, and changing perspectives all shape the outcome. Understanding this makes the system feel less random. When you stop focusing only on price and start considering the decisions behind it, the picture changes. You begin to see movement as a result of interaction, not just data. This shift in perspective brings clarity, because markets are not moved by numbers alone. They are moved by the decisions people make every single day. People constantly react to news, expectations, and what they believe could happen next. And once you begin to understand that, the market starts to feel less random and more understandable. So the next time you look at the market, don't just see numbers rising or falling. See the process behind them, the changing expectations, the different viewpoints, the constant flow of decisions, because that is what truly drives movement. And once you recognize that, you move from simply watching the market to actually understanding it. And if you enjoyed this video, make sure to like and subscribe for more content that breaks down complex ideas in a simple and understandable way. There's always more happening beneath the surface, and the more you understand it, the more clearly you begin to see the world around you.